Welcome everyone to office hours for TradersPost on this September 20th, 2024. It's the Friday after the Fed cut, and we're all feeling good. Everyone's feeling good. Markets up. When they give us good news, it's a good quarter coming up. Hope you guys are doing well. I'm joined as always with Mike Christensen and John Wage, CSO and CEO of TradersPost. How are you guys doing?
Doing well. Appreciate that. And yeah, it was definitely a volatile start to the day. You know, for us in Colorado, we get the news for the Fed cut at 12 p.m. Everybody else gets it in the afternoon. So there's no taking a lunch for me on Fed decision day. And the breakout that initially occurred, I was like, wow, this is really bullish. And then we closed the end of the day sort of down again. And then the overnight session, I think, was what really told the story, which rallied pretty hard. So I was really happy to see how things looked the next morning. And I ended up tweeting, "Thank you, Jerome," on Twitter. So, because I'm definitely very happy with the results so far.
It's so funny. The 50 basis point cut. I mean, we'll talk about it more in after hours, but it's surprising. I think it's the first time it wasn't like a 90% guarantee. Like the market didn't nail what the cut was, so that was pretty interesting.
Yeah, it seemed. Obviously, we flip flopped multiple times. The futures market was predicting back and forth as to whether it was going to be 50 or 25, and that was the big debate for almost 3 weeks. And then they finally did the 50 basis point cut. The market said, "Okay, well, this probably is bearish, right? Because this should signal a recession." And the market said, "No, we don't think. I think we're good. Let's just go ahead and keep going up." Let's rally through a rate hike, and then let's rally through a rate reduction.
Well, I'm wondering, John, is there a lot more webhooks that come in like around events like that, like the Fed cut?
We had a spike of traffic that was about 8x our normal rate right when the Fed announcement happened. So yeah, our systems were they were heating up.
That's awesome. Well, the thing that's been like for me, just as far as the TradersPost is concerned, has been how much more talk there is about prop firm trading. I don't know if you guys are seeing this uptick, but within Discords, within support tickets, way more people just openly like talking about it. And I don't know if I was just like there was a summer lull, but I don't seem to remember this as much before. And I wonder if it's like a market up, participants up sort of situation where as long as there's motion in the markets, people go, "Why? I don't want to miss out on it," and then they find reasons to participate, and they find the prop firm angle. Are you guys seeing this more interest in prop firms?
For sure. Yeah, definitely. Over the last couple of years now, there's been a market increase in prop firm activity. We're definitely seeing it within TradersPost as well. People connecting Apex and Trade accounts with prop firm designations to them. So we definitely see the demand increase and see why it's happening. I mean, it's these days it seems like it's more accessible than ever for people to get funded accounts. The industry seems to be sort of orienting around that type of approach where I think many beginner traders, sort of new to futures, especially leveraged products like futures, are struggling with the emotions of trading. So trading practice capital is a nice way to kind of like hone in on a strategy and be rewarded for that process. So I definitely like it. I like the journey that a lot of these traders are going through to learn, but also benefit from their training as well.
I'm really enjoying not losing my own money. It feels pretty good. I gotta tell you.
Have you guys passed the evaluation yet, or are y'all still working on it?
No, still working on the evaluation on my end. I don't know about you, Mike.
So I passed mine this morning. Very interesting trade. I mean, almost perfect setup. I ended up shorting NQ below VWAP, which is a very classic setup for me. I tend to trade VWAP rejections, and was able to pick up, I think the target is 3,000. So I was able to pick up 2,800 on this one trade this morning.
Wow.
And what's funny is I was, sort of working on my space in here, and I actually walked away from it, and I had a take profit set, and I wicked that take profit. I think I was off by 10 ticks and managed to get it perfectly. So I'll share my trade with the Discord group.
Oh, such a good feeling. It's excellent. All right, and John, you're going to get into prop firm soon, and then that'll be fun. All right, so let's start off with the questions that we have for this week. This first one, I have to be honest, I don't know the answers to. It's specific to MT5, and someone was asking if it's possible for MT5 to send signals to TradersPost, because I know it's possible to send signals to MT5, but I wasn't sure if the other way around.
Yes, so there is a method to send an HTTP request from MT5 if you write it inside the EA script. We've had other users in the past assemble their own versions of this. And essentially, you can build an alert from an EA script that can send along a JSON payload. It's a little bit of extra work. I was starting a process to show how this would be done, but I was struggling to see the use case. So I think in general, if you're interested in trying this in MT5, reach out to us at support@, traderspost.io. We'd love to get your use case, like which version of MT5 you're using and with which broker, and specifically which asset class you're looking to trade. So I'd love to come up with some examples and kind of help with that process, but it is possible. And I think we're happy to sort of help you discover how that should work and maybe help you write the script as well. Because we would like to showcase more ways in which MT5 can be used to work with TradersPost.
Did you guys get any more feedback on the issue with the CFDs no longer being allowed in the United States and the popularity with MT5?
Yeah,
still seem to be like sticking around.
Right. That's partly what made me put down the MT5 work, because it seemed like most of the groups that were using it were all CFD groups. But if there's somebody trading stocks or, options or something through MT5, I'm not even sure if that's possible. That's what I'd love to know more about.
Awesome. That makes sense. Plus, if they're sending a signal out from MT5, maybe they're using the data, the interface, and then it doesn't matter with the CFDs because they're trading their broker through TradersPost.
That could be. Yeah.
All right, next up, someone was asking if they can sign up for more than one TradersPost account using the same credit card, because some other services, they don't let you use the same credit card on more than one account. Can they do that?
I think that would be allowed. We don't have any restrictions. Stripe would allow it. So yeah, you could do that if you needed to.
Yeah, a user in the Discord did state that they have multiple accounts and they're doing just that.
Yeah, we definitely don't have any restrictions for it. We don't really look for it. I think it's generally the reason people are doing it is because they want to modify their subscription to allow them more access to more strategies and brokers. And in the future, we're looking to sort of solve this problem through an a la carte pricing model where you can start from a base price and then add on as many things as you need and sort of modify your monthly subscription from there, so that you don't have to manage multiple TradersPost accounts. It's obviously a burden for you, so let's make it easier for you.
I think someone was saying that, if I understood correctly, that they had the two user accounts as like sub accounts or whatever on each other's, and so they have to remember where they are and what they can change and log in. So yeah, if I mean, it's the first time I've ever heard of this this issue, but the new pricing model might be very helpful. In the prop firm vein, can prop firms tell if you're using TradersPost? Now, I should preface this by saying we're not in any way trying to circumvent rules for prop firms. That's not our kit and caboodle. There was this nice discussion of people sharing the terms and conditions of the what I think in this particular case it was Apex funding within Discord, and what they were saying is that semi-automated trading is fine to have a system to do semi-automated trading. It's completely automated ones that at least that one was saying that they want to completely avoid. They don't want any set it and forget it. They don't want you walking away. They want you essentially manually trading and using the semi-automated system in order to facilitate the trades. So that makes a lot of sense to me. But I guess in the spirit of this request over here, is it possible, like, is there any information that's transmitted at all from TradersPost that would indicate to a broker or what have you that TradersPost is being used?
Yeah, I would think that that information might be translated from the broker to the prop firms, because there is a close relationship from the brokers to the prop firms. They're well aware of the types of accounts that are designated for prop firm activity. And of course, every request that is made from TradersPost to the broker is designated as a TradersPost trade. So all of our brokers are aware of the volume of order flow that is coming from TradersPost. So it is fair to say that in all likelihood, the prop firms would be aware of the activity there. But I also want to second the disclosures in terms of service with these prop firms, having now started a Top Step account and really kind of investigating it myself. I've looked pretty closely at their terms, and the one thing that I've noticed is they do not support the idea of trading bot activity, because specifically they're looking for multiple trades being conducted within small numbers of seconds, right? So if you're on the like 1 second chart and you're trying to trade like an HFT style and you're in and out and trying to scalp really quickly, that's what they're discouraging. But if you are trading something on a longer time frame, like I was today, I was in my trade today for an hour and a half. So that's 1 buy, 1 sell, and that's being sent through TradersPost in an automated strategy, and that's perfectly acceptable, at least from what I can tell from the terms of service. But I would encourage everyone to, of course, confirm with the prop firm that you're working with and read their terms of service pretty closely about what they support and what they don't. Of course, we know as an organization that none of our brokers have any issues with the trades that come through TradersPost. So you're not going to get the issue from the broker, but the prop firm terms are, of course, subject to change. They're highly stringent. I think some of the rules are very restrictive. So just be careful about the terms of service with each prop firm, because it changes from firm to firm.
It's such a fun vector for traders. It's so useful for the rules that they have set up in order to become a better trader, especially at the beginning. Like, I mean, I'm sure you guys had the same thing. Well, I don't know if you get the same thing, but my God, the number of blown out trades that I had when I first started. If I had to start with a prop firm sort of idea, then I would have immediately seen that there's a mistake. But to sit there with 50% drawdowns and go, well, I guess this is what it is. I guess sometimes I'll have 50% drawdowns. Now to me seems so ridiculous. But then also for the once you get on a roll and you have your strategies that you have set up and you know what you're looking for, the idea of being able to use a service like TradersPost just to help facilitate the whole thing and just make your life easier the way that you would use any tool, any productivity tool. I really love that sort of idea. And I'm very interested in seeing how you guys are modifying the platform to add features, add the polish in such a way as to facilitate for newbies and for long-term veterans in their trading journey. Pretty interesting.
For sure. Yeah, I totally agree. I think this is probably the best way to get introduced to a leverage product like futures without that potential of just completely draining your account. I mean, if it definitely happened to me early on a much smaller account, but I blew out the first couple accounts that I had and lost quite a bit in futures early on. And it is not fun. I would have rather have lost, what is it, $150 to a simulation account than lose thousands of dollars of real money to a futures account.
Yeah. Does it make it seem like to you like the pitch to not try it? I'm not understanding the argument not to try it. When I first heard about it, people were saying that prop firms are scams. These are all just scams. And I thought to myself, well, of scams I've seen, if it is a scam, it's like the least scammy thing I've ever seen before. And they're like, well, they're paying you out from the failures of other people. I go, well, that's what the market does. It's paying me out from the failures of other people too. So where exactly is the problem here? Why wouldn't you give this a shot?
Yeah, I guess the one argument I would have is lots of the rules for a lot of these prop firms that I've looked at are so stringent that it kind of really falls outside of my trading style. Right. I'm willing to take larger risks than they're allowing, and I think they've created rules that are so specific that it's kind of difficult to really manage risk in a way that's appropriate to the upside. So you find yourself needing to take a little bit more time, manage risk a lot tighter, taking very small steps along the way, which is fine. But if you're growing, it's pretty tough to trade by some of those standards. And I think that's the complaint I'm seeing from a lot of people, is that the rules are so stringent that it's really difficult to succeed. And I think that they'll probably get more and more difficult over time, especially as people's skill improves over time, to the extent that it may be a very small number of people that are ever awarded any kind of live funding to their account. So that said, I think the other consideration to make from a prop firm account is that you're kind of fixed in terms of the reward you're going to receive over time. They've limited the amount that you'll be paid out over time. But if you're trading a futures account with your own capital, it's effectively an infinite scale. Like if you're capable of building an account, you're able to reinvest your own profits back into your own account over and over and over again. And that compounds, I think, much faster than using a prop account.
Fair enough. All right. Okay, so this is a question. It came up, but I also have this, this desire, and that is, can TradersPost help me market my strategy? Not that I have any strategies I want to market, but the idea of having a marketplace of strategies seems pretty interesting. But until that day, is there any scenario in which we interview someone or we post something online and we send out an email of like, hey, this strategy is pretty interesting. You guys might want to take a look at it. I suspect I know the answer.
John, do you want to take this one?
I think it would be better to do it indirectly. Have you join us on our YouTube channel, a guest blog post or something like that, but not just like an outright buy this guy's strategy. That would be kind of my take on it.
Yeah, I'd agree with that. We are definitely not in the business of promoting any particular strategies. We've definitely done some examples just to show people how our system works and how you can effectively integrate with us. But we do want and continue to want to operate under the premise that you're kind of bringing your own strategy. It's a BYOS approach, right? Where you've got to sort of look for the strategy that works for you, or join a group that has an existing strategy. And we'll still kick around some ideas in the future about what a marketplace might look like. But I think it's going to be fairly constrained and fairly limited. We really just want to support the technology for now. Marketing it would be, or marketing any kind of group or strategy would be sort of unfair to the rest of the people that are using the platform. So we're going to be pretty careful about that.
I can imagine. But like what John was saying, like it would feel so interesting to have anybody from our group. Let's say you've been here for a while, you have a strategy you've been working on. There might be a place for us to do like an interview with you, just to see what our community is actually doing and get your feedback. Not endorsing in any way, but to have you articulate it.
Yeah, I think we are happy to at least have people on the Trading Bot Sessions show, just to talk about their approach, talk about their community. That's really more of a benefit to everybody from the perspective that we're just journaling the journey that all people are in, and how this group might be benefiting their users. But in terms of actually like promoting the strategy within the software, I think we'll see what that looks like in the future.
Sure. All right. Is it possible for an order to open on a futures contract and then the exit order happens on the futures contract, but after it's rolled over, and then we have this huge price discrepancy between the opening and closing?
Yeah. So I think the question is largely around the idea that maybe you're holding a position in a futures contract that has rolled over some period of time, right? So like the expiration took place, it's already in the new contract with the broker, but then the pricing data that decides when to close the contract is coming from TradingView, which then sends a signal to TradersPost. There are some issues with that approach, because the way that the brokers roll over a contract, TradersPost rolls over a contract, and TradingView rolls over a contract can be different in all three cases. TradingView rolls over their contracts based on volume and effectively kind of an algorithm that looks for the next contract in front to have greater volume than the front contract. The moment that takes place, then they roll it over. TradersPost works by a 2-day rollover period. So 2 days before the expiration date of the contract, based on what the broker tells us, is when we roll over the contract. And then, of course, the broker can roll over their contract in sometimes unexpected or unique ways. But it should be fairly in line. That said, we want to remind users to be on top of this. And this is part of the manual process of monitoring your algorithms. It's not like you just set this stuff and forget about it and go on a vacation for a month. This is exactly the type of maintenance we're referring to when you need to check in on your strategies to look for those rollover windows and make sure that the symbol being sent from TradingView is lined up with what you rolled over into.
Yeah, you're running a factory here. You're in an industrialized process, and you got to have people along the ways to press the buttons in case the ketchup bottle gets stuck. I get that.
Yeah, for sure. Exactly.
Okay. Someone straight up asked us, do we offer a white label version of TradersPost? They want to take our service. They want to resell it. I get that. It's so good.
We don't today. We've thought about it, but it's a pretty big different business than we're in today. And originally, I kind of really was wanting to be the owner of the customer. So I don't know if in the future we'll do it, but no, the technology isn't capable of doing that today. And also, I think it would be more expensive than people would be willing to pay, frankly. I guess depending on how we white labeled it, like literally if it was like a separated infrastructure where it's like literally its own database, its own servers, it would be really expensive, way more than I think people would be willing to pay. But it could be possible maybe if it was infrastructure that we maintained and it's not like you're running our software on your infrastructure. But I don't know. I'm not too interested in the white labeled version. I kind of like the software as a service where we own the customer. I don't know. What do you think, Mike?
Same thing, but if you guys want to reach out via support and promise us lots and lots of money, then sure, that might perk up our interest. No, I think in general, I agree with John. We've worked hard to build a brand that is focused on delivering a tool that makes automation really, really easy for customers. And part of the white label concept, I think, works in theory in that a closed community now has the ability to kind of like set their own price and manage their own process, but then they're managing the support. We're having to figure out difficult details around, well, who owns the support process? What if our expertise is better than yours? Maybe we should handle support. Well, what happens if a customer complains? Is that for us to service or you to service? And there's just these partnership issues that tend to occur when that happens. That make the relationship difficult. So from a brand perspective, we typically are interested in just managing the TradersPost brand, the support process, and delivering a high quality service to our customers.
Along those lines, then I'll just ask you flat out here. I was devastated the other day when autocode.com went down because the creator, owner, or whatever, decided to go work for OpenAI. And so if you're going to be turning down white label solutions at oodles and noodles of dollars, I'm assuming you'll turn down OpenAI when they come knocking on your door in order to hire you or any other big brand.
I mean, 100%. There's no way that Sam Altman offering us billions of dollars would be of any interest to us.
All right. So this question, I don't know how you're going to answer this. I know what my answer is, but let's see. If you had to choose, what's more profitable, futures or options trading?
I love how people ask these like binary like questions where it's just like how could there ever be an answer for that? Like it's an impossible question.
Yeah.
And I mean, I don't know. I feel like if you're asking that question, you're off the mark.
Yeah.
So why would you choose to trade futures then over options, or options over futures?
Well, I think that's a better question. I mean, futures isn't as complicated as options. You don't have any of the time variables, um, but you still get the leverage. You still have to deal with contract expirations, so that's more complicated than trading just straight up equities. But I don't think there's like an ultimate like this is the best asset class. It just depends on what your goals are and what your risk tolerance is, how much work you want to put into it. Um, I think those are the types of questions you should ask.
Yeah, I think the framing of the question tells me this is somebody kind of early in their journey that indicates that they're trying to make that choice of like, where should I be putting my effort here? And the question about which one's more profitable is a tough one to answer, because John's right. It's not really a binary question. Think of it more like, what tool should you use in order to achieve your trading goals? You want to use the right tool for the job. And options contracts are designed to solve a specific type of problem. Futures contracts are designed to solve a specific type of problem. And they can be used in totally different for totally different reasons and in totally different contexts. Like, for example, I might say that I have a long portfolio of a bunch of stocks, or even just I'm holding the SPY, and I want to prevent some kind of volatility event against that drawing down. So I want to create some kind of hedge against that. Well, I might use options contracts, or specifically long put contracts, to protect from some of that downside. And I'm willing to pay some of the premium for that. And so the risk that I'm taking is whatever the cost of the premium is. If I'm better at trading trend, though, and I have some skill in that space and I'm more of a trend follower, I might be more inclined to use futures and use futures as a hedge against that drawdown. So, I mean, if you think about it from that perspective, those are just two of many, many different reasons to use different products. So I would think more about the question from a, why am I trading this and why am I using this type of instrument and what problem is it solving, than trying to determine which one's more profitable. Because the answer is they're both profitable if used properly.
Interesting. Because I would make the claim, although now I'm going to sound stupid with what you guys just said, that options are more profitable because the non-recourse leverage that you get access to can be significant. You can find an imbalance within or not an imbalance, but a skew where
And the losses are just as big too. I mean, the loss opportunity is equally in size as the win side.
if you sell options.
No, I just mean like if you're long calls, like it could move up very fast and it can move down just as fast as it can up. So
that's right. That's
yeah.
right. And so,
especially if you're just trading price action on options, you have very high potential of losing 30, 40, 50% of your original investment. And of course, yes, under right conditions, you've got the ability to capture 1,000% upside on options. I totally get that. But I guess the stats kind of speak for themselves. Like, the vast majority of options expire worthless. And many people in general tend to lose in the options market just as much as they lose in any other type of market. So that's why I'm saying it's not like it's if you're not using it properly and you're just using it because it has this leverage component to it, you're more likely to face losses you didn't anticipate because you didn't truly understand the way the product works and how you're using it in terms of other investments. Is it a diversifier? Is it a hedge? Are you speculating with it? Is there a specific strategy? Like, what problem are you solving by using that contract?
I guess if you look at it from like, the leverage is higher on options than futures. The asset class doesn't determine the profitability. Your trading determines the profitability. So options, yes, are 100. The point value, the multiplier is 100 on options, whereas futures, it depends. It can be 2, 5, 20. So the leverage is lower. But yeah, options definitely have higher leverage.
If I want to, I mean, it's always relative to your account size, right? So like, I can open an NQ contract with a $5,000 account as long as I trade intraday, and that is 100 times bigger than my account in terms of notional value. So very quickly, I think you can expose yourself to similar types of leverage, and then it's just a question of where are you gaining the upside? What are you using this for? What are you trading exactly?
And if it truly is someone just getting started,
Don't do futures or
it
options.
probably shouldn't be futures or options. It should be one share of SPY,
Right.
and like the goal is not to make money. It's to learn how to use the tools, learn price action, learn the systems, learn your emotions, create a plan, like ignore the fact that like you just shouldn't be worried about profitability. Like there's just so many stages you have to go through first before you get to that point, and do it with one share, so that you can learn all those things with a low tuition cost.
I got to be honest. I love questions like this. Keep the simple ones coming, because it's so fascinating to me how what seems like a very simple question at the outset can prompt such a complex response. Like you're going to get like an info dump of why did you ask that question that way? Here you go. Here's a whole bunch of things you need to understand.
Peter says, I learned nothing if my heart isn't pumping. I mean, it's definitely true. Like there's a lot of things you got to learn. The technical stuff, like how you use the tools, like that's the first part of it. But then, learning how you react once you actually have size on the table, I think is like the bigger hurdle. But you don't want to have to like try to learn all of the things all at once. Like you put on size and you've like never used the tools before. You should probably learn how to use the tools first before you put on size, because then you're going to be dealing with all of the things all at once, and it probably won't go very well.
Agreed there.
It's like having a baby by accident. You don't want to do that.
One trade that I do recommend highly, though, not to interject and throw in a shameless plug here, though, is the trade of just hitting that like button or subscribe and following us here in exchange for us making more content like this. So definitely hit the like button, hit the subscribe, leave a comment, reach out to us, ask questions, keep doing that kind of stuff. That's the best trade you're going to make.
Well, for sure. The last, he gets a Shure mic, he gets a nice camera and lights, and all of a sudden he is a YouTuber. I love it. This last question, though, if we get a good answer on this, I'm sure we're going to get lots of likes and subscribes. And that is when Binance.
Ooh, spelled perfectly too, by the way. Thank you for that.
We're close. I'd say a couple weeks away. It's like at the end of the assembly line. Just got to take care of a few last things, to test a few last things and get it pushed out to production. And then once it all looks good in production, we'll lift the curtain. We'll kind of launch it. We call it like a dark launch, where like all the code goes live, but it's not available to anyone. And if everything looks good in the dark launch and there are no issues caused by introducing the Binance integration, then we'll lift the curtain, make the announcement, send out an email, write a blog post, do all that fun stuff.
So I got to share a little story here. I got started in the crypto automation game back in 2016 and 2017, and Binance was actually one of the first integrations that I did. And Binance's API is one of the most annoying APIs in the entire crypto space. And it was actually kind of revealing and somewhat validating to watch John work on the Binance API, because he went through the same exact struggles that I did back in 2017, because they haven't changed anything about their API, by the way. Like they've made some improvements, but it's exactly the same limitations and struggles that I went through early on in another product. So John, did you have any like specific struggles that you wanted to share? Because this has been fun for me to watch.
I mean, and it's not just Binance either. I mean, a lot of times you can tell when an API is built that it's like built by like a business person, or not built, but designed. Like the specs are designed by someone who knows nothing about being a developer, and it looks great on paper, and then it gets handed off to a developer like probably a developer in India or like some country. They're not a trader, and they literally just like follow the spec exactly to the T that was designed by the person who's not a developer. Maybe they understand finance and trading, but they don't understand what it's like to be a developer and like what you expect as a developer. But yeah, just weird stuff like when you fetch the orders list, you have no way to say I want like this specific
All
ticker.
orders.
Yeah, all
They
orders.
require.
Yeah, it's the
Yep.
reverse. You have to specify a specific ticker. It's like, well, what if I want to see the full list of all my recently closed orders, stuff like that.
Mm-hmm.
Yeah, there's just a lot of weird stuff. Like that.
I think another thing I noticed, and this was a fun one to reconcile, is that they reuse order IDs. So they're all numeric, but because they've created this dimension of the pair or the symbol as they call it being a required field for the order endpoint. When you ingest orders, the order ID could conflict with an order ID on another symbol. So you might have BTC USDT with order ID 1234, and then pull back Sol USDT, and it also has order ID 1234.
Well, dang, I didn't know that. That might be an issue. I got to look into that.
Oh, great! Here, I just kicked out the timeline for Binance.
And how would you even know that? Like, it's just so weird. Like an identifier. The word is literally an identifier. Like, I don't get it. It doesn't make any sense.
The reason I figured it out is because I didn't have the symbol as a dimension in the database, but I had a unique key on the identifier, assuming that this would be unique, and it wasn't. I started to ingest the data, and all of a sudden I got a conflict on the ID.
It doesn't make any sense. And I don't even know how, like from a database perspective, like I feel like you would have to like do extra work to make it behave that way. Like databases just like behave that way by default when you have identifiers. Like they're guaranteed.
It's clear that they have different databases per symbol. They all live in their own universe.
I see.
Yeah.
Yeah. I mean, I guess maybe there was usually there's an explanation for that stuff. It's just, we don't understand like the constraints that they were working within, or maybe they had scaling considerations and like, that's why they made that decision. So if I understood the full picture, I would like, I guess, understand it. But, every other broker that exists doesn't have that requirement. And like, there are systems that are much, much larger than Binance, Facebook, for example, like they have unique identifiers for things, and they're unique across the whole data set. So, I mean, if they're able to do it, I feel like you should probably be able to do it too. That would be my take on it.
Yeah, I agree. I don't see the infrastructure constraint, but you're correct in that I would be making assumptions about how their infrastructure was designed internally and why it was designed that way. What we do know is that no one else seems to be following this procedure. This is unique to Binance.
I mean, they could have, and maybe the things that I can think of that would make sense, like maybe they inherited some like legacy tech or infrastructure that Binance was built on top of, but that seems unlikely because Binance is a brand new company. I mean, maybe they bought a company and that's like the foundation of something that they built on top of.
I don't think so. I think they actually built it from the ground up, because my understanding is that CZ actually has a background with he from another firm, and they had their own matching engine. So he had technical experience in building a matching engine in the past and had experience in HFT. So it sounds like it was an early design decision, and it was probably an outgrowth of something specific that he learned from his background. Yeah. And they just stuck with it. But now we're all paying the price for that design decision.
Yeah.
So next Tuesday, it's coming out. Next Tuesday.
Yeah. Right. Well, now that John's learned the order ID problem, we'll see.
And it's tough, and I don't remember seeing anything in the documentation about that. I probably just missed it in the like. I mean, that's part of the issue, is that like when you have that many like little edge cases, like in a 500-page manual that documents all those things, like it's really unintuitive, and it's easy to miss that type of stuff. And they're just like, oh, it was in the documentation, but it's like, well, it doesn't make any sense.
No. Yeah. I don't think it's stated. You're right. I ended up creating a hash of the symbol plus the order identifier and using that as the unique key.
Yeah, I'll have to make that same change.
Okay, well, you got a little peek into the development process here. If you like this kind of nerdy stuff, let us know, and we'll tell you more about the stuff we're working on behind the scenes.
Excellent. All right, so we're gonna leave that there for this week for office hours. We're gonna move right into after hours, but we'll say goodbye to John and send him on his Binance way.
See you guys.
See you.
This week has been so fun, Mike. I gotta say, any week with volatility, forget school, forget summer where kids are off and you have to deal with family and go to the beach and do all these barbecue things, whatever. I want to be at my desk on Fed meetings. I want to be here to see what happens in markets, and it did not disappoint.
It did not disappoint. You're right.
Yeah.
It was a very interesting overnight session for sure. You know what's interesting too is that as volatile as I wanted it to be, the VIX didn't even poke its head up above 20. So we're still in this kind of like low volatility zone, in my opinion. It's not quite exciting yet. The ATR, even looking on higher time ranges, is still kind of tight.
Well, we're going to go over some stuff today that might help the markets perk up, because we're looking forward to some pretty interesting things coming down the pike. For the headlines for this week, so to go over here, we had, of course, the interest rate Fed cuts, right? So the Powell went ahead and cut 50 basis points, and the stock market surged. We also have the Bitcoin that jumped massively, as well as some individual stocks. And the third item on our list is Microsoft, who needs a lot more power for AI, who, I don't know if you heard about this, has bought a nuclear power plant. Ooh,
Incredible.
That sounds like the beginning of a dystopian or utopian future.
I'm going utopian. I'm an optimist.
All right, so I want to start off with, I'd love to start off with my favorite guy, Carson, who from Kai Volatility. So I'm just going to play a video over here, and we'll take a look at it.
Carson is back with us from Kai Volatility Advisors, Senior Managing Partner. Ken, welcome back.
People love to look first of the month to the end of the month. And actually, the seasonality is much less tied.
Let's rewind that and start that again.
Yeah, where's the video?
It's freaking restream. Come on, buddy.
To a calendar month, and it's much more tied to the...
Maybe we're just going to get audio today.
No. Oh, you can't see this video?
Mm-mm.
What about now?
Nope.
Oh, I see. 1 second here. Then let me play it on my computer.
We are having some technical difficulties.
Second. I did not realize that. Maximize. All right. Now I get how my podcasters feel when their technology doesn't work. Come on, you. Okay. There you go. All right, and I don't know if you're gonna be able to hear this. Are you gonna be able to hear this? Let's see. All right, you're gonna have to just hear the audio then, because it's playing on the stream, but you can't hear it. You can't see the video.
I see it. Let's see if we can hear it now. Oh, nope, can't hear it now.
Okay, so we're gonna play the audio and then
To the expiration cycles.
Okay, yeah. So you think in terms of options calendar?
It's so important to understand it's the primary driver of the season.
Jiminy Cricket. Rewind. Here we go.
Carson is back with us from Kai Volatility Advisors,
You can hear that, right?
I can.
Okay.
Senior Managing Partner. Ken, welcome back.
People love to look first of the month to the end of the month. And actually, the seasonality is much less tied to a calendar month, and it's much more tied to the expiration cycles.
Okay, yeah. I was gonna say, you think in terms of options calendar.
It's so important to understand it's the primary driver of the seasonality across the board. There's other effects that are part of it as well, but that's critical to the actual forces that drive the seasonality. We are through expiration.
Yeah.
Right? And actually, for all practical purposes, 2 weeks ago, we put the kind of all clear sign. Once those Von and Charm flows start kicking in and you haven't had the volatility in that window, the downside that you needed, it's all systems go. And that's what we were very clear about that. And sure enough, this last 2 weeks has been an incredible run. But I think it's critical to keep in mind when the market is up 20% for the year, you've had, by some calculation, $50 trillion of buyback in that year, a releveraging effect. And some portion of that, about 10%, we can wave our hands at it, comes January 1st of next year. That's $5 trillion in a world where $100 billion to $150 billion is what the incremental change and moves in markets today. The incremental amount that's pushing this market up 2% today is probably about $150 to $200 billion. It's nothing. It's nothing. A 2% move in the market is like adding $1 trillion, right? So this is a leveraged, low cap venture capital deal, essentially. That's what the market is at baseline, and people don't really realize that. So that effect is so important. And then you have incredibly slow time in markets in terms of 60% volume weighted time during the last 2 months of the year, from mid-November to mid-January, actually.
So the action's very important there.
That's important. And then last of all, you have the biggest expirations of the year in December, always December and January. That has a massive amount of skew in it, much more than it usually has, significant amount of vol. That creates massive, that's that wall of worry people talk about. That's the actual supply and demand that drives that flow. So you're cutting time down on a massive amount of skew and volatility in the market that needs to force these Von and Charm flows right as you have massive buyback January 1st in the market on the releveraging effect. The last 2 months of the year, you'd be insane to try and short this market in that window, in my opinion.
Is it such that if you want to put on like some kind of a hedge before the end of the year, that it's best to do it around that event that has catalytic potential in it, if you think the catalytic potential is that high?
Yeah, it looks high to your average person. If you don't know what you're doing, you're going to go sell that, you're going to buy things around it. But the number one thing to understand is that event is the thing that's going to drive the end of year up move in the markets, or volatility broadly, up or down. And if you're not exposed to that, you're in big trouble between now and then. So they have this ace in the hole, which is demand, and this is a demand push economy. And millennials in particular looking to get into homes. And whenever they spur that demand, all of a sudden get surprises to the upside in terms of every single number across the board. So I would expect the same to happen in this period. The wealth effect, if I'm right, this market goes higher here, will continue to also kick in and get in that flywheel where all of a sudden, this demand push economy, things are hot again.
Okay, so
that brings in the steepener, right?
Exactly. You know exactly where I'm going, which is that's the one part of your thesis from this year that you're looking for it to come back into, because you're looking for like 5%
this
plus.
Is exactly what we called for, by the way, 3 months ago. Not the end of the year number, but the action here. We've been saying for 2-3 months the Fed's going to be more aggressive than people think. They're going to lower the front end of the curve. The part that hasn't happened yet, which we still believe is coming, look for it, this is your moment, is for as that happens, inflation to start kicking back up. And if that happens, which is what I see coming down the pipe, the steepener is the perfect trade, right?
Okay.
Because the front end is being held down by the Fed who's stimulating, and now the back starts taking off. We have not seen that in 20 years. That's important. We're going into an election. Policy matters. And there's a couple really big things sitting out there in the election that very few people are talking about.
Real quick, hit me what you think is the big one.
Immigration is the biggest by far. The core reason labor inflation hasn't been worse than it is because of an open immigration policy here in the United States.
Fair enough.
It's incredibly unpopular, but that's what's holding down inflation. And the second you close those walls and you close out inflation, labor inflation will go through the roof if this economy reaccelerates.
All right, so that's him talking about on Schwab Network about the flows that are going to happen over the next several months. You guys could take a look at the full video that's on YouTube. But I find this to be absolutely fascinating because guy is like Babe Ruth calling the shots months ahead of time. So just to summarize it quickly, in case it wasn't clear there for some people, is that he's talking about structural flows due to options. And so we had options expiry that happened like today, basically, where if there was going to be any drop within the market, any weakness within the market, you would have wanted to see it now for that to then be exacerbated to the downside. But since that doesn't happen, that those hedges are basically bought back, and you have the market that basically the dealers who have to buy back the stock that they shorted in order to hedge their positions, and you have these flows that the stock market moves up. So that's one of the reasons why the catalyst that we had with the 50 basis point cut from the Fed, plus no event that caused a drop in the market, then causes retail and institutional players to buy. It causes the dealers to cover their positions, and all of a sudden you have this, like we saw the other day, 100 points up on the S&P overnight, and all these stocks gapping up because all that downward pressure is now gone. And he's saying we ain't seen nothing yet. That we're going to see a massive rise in these assets between now and mid-January because there's the window of weakness. The next option expiry happens in December when everyone's on vacation. So the odds are, unless there's some event a world event that happens, the odds are that we'll move up, just like we did last year. I don't know if you remember, from October 2023 to January, it was just this massive run up in crypto and in assets. And he says this sort of thing can happen again this year. I find that incredibly exciting because it's true. The path that he has laid out so far has hit pretty dramatically, and the Fed cutting 50 basis points, not 25, 50, is super surprising, because the market wasn't positioned for 50, like it wasn't fully positioned for 50, which means that the central bank is even more dovish than what we anticipated. So we shouldn't expect any cuts coming in anytime soon, maybe for the next year.
I think just look.
Not cuts, raises. No raises coming.
Yeah, definitely no raises. Yeah, I don't see any rate hikes in the future. It's really a question of these next two meetings that are left for FOMC, whether those will just be two more cuts at 25 basis points each. And I'm fairly confident that'll be the case. The futures market tends to agree with me there. If that's the case, I could see some support for the bull case there on that. And you're right. I think what was interesting about the end of 23 was that most of that rally actually started to begin at the end of October, prior to what we were, sort of describing as the Santa Claus rally towards the end of the year. So we got an early Christmas present, right there in October, which ended up signaling the bottom for the rest of 2024. And that continued to be a fantastic rise in overall markets. So we've drawn down now, we've pulled back and retraced quite a bit in markets. Now the question is, do we continue from here and get some of that early Christmas present before the end of this year?
So that was the Santa Claus rally, and Ken goes on to explain it in a video he does for Real Vision. I'm not going to play it here, but I'll put a link to it inside of the description. He explains why the Santa Claus rally happens, and that's because of when the stock market goes up by the end of the year, the collateral value goes up. And so I think the market's up 20% this year. And so if it closes that way, well, then there's more money to be reinvested in January from people whose portfolio, their assets are not worth more. And so you have people who front run that in November and December, knowing that there are going to be forced buyers in the beginning of the next year, and then the year starts, and then those buyers buy in. I mean, they don't go all in right away, but they do start buying as of January, because their history is now wiped clean. They could start again now from January, and they could start putting those positions on, and they don't really have a choice of not reinvesting that money in, right? If they have a $10 billion portfolio, and that portfolio goes up by 20%, well, they have to reinvest extra more money, because they're already leveraged, and they have to continue with that leverage in order to keep their risk steady, which is what they're promising their customers. So it's really fascinating that the dynamic of rising assets causes more rising assets. And that the amount of money that's required to move, let's say, the S&P by 2% is like $100 billion, like $50 billion for every 1 percentage point. So you can imagine a $60 trillion market that goes up 20% in value has trillions of dollars now that can then be reinvested. If you have even a fraction of that goes into the markets, well, then you're going to have massive moves to the upside.
Fascinating. I definitely need to spend more time watching his stuff, and I really lean on you, Tom, as my guide here on the option side. Admittedly, options are less of a. I haven't gone down the rabbit hole for options. Let's put it that way. I've been in crypto and stocks and in futures for much longer and much deeper rabbit hole. But I need to get up to speed. You got the edge here.
Well, I wanted to. I was actually going through. When I went through for this show to get clips for all this, I have whole sections of explaining more 101 that Kim does, the sort of effect and the value of options. But I was like, okay, I'm not going to put a half an hour thing into here, but it might be interesting to share some of these clips out on not just from him, but also from Michael Howe and from Lacey Hunt and from different participants who have pretty significant knowledge with the bond market, the futures, and options, because I think it would be interesting for people who watch us. But the thing I wanted to bring up is that he really makes the case, and I never heard him make this case before, that options, he considers the equities and futures to be a derivative of options, because the stock is essentially a two-dimensional view of what the asset is, whereas the options gives you the whole volatility surface and takes the future into consideration. And so you get this it's almost like the stock is a 2D representation snapshot of right now of what the option space is actually doing. And because it's leveraged to such a degree and there's so much money there, that the options could end up moving the price, like we just saw. The dealers have to then cover, right? They're selling you puts because you think the stock market might go down in September. Well, they sell you the puts, which is they're giving you an insurance that if it goes down, they'll pay you out. Well, they have to hedge. They have to go sell the futures now. They have to sell the futures now so that they can sell you that put. And so when the put doesn't get monetized, well, now they have to buy back the future. They have to buy back. And so the options are actually helping to drive large players, even though retail investors or some institutions are buying insurance. They're the insurance market. So they have to be delta neutral. They can't be directional in any way. And once we get that in our heads, that the way that the option space is structured is completely informing long-term decisions, completely modifying the flows within markets, then it becomes like, well, not understanding an understanding of what the options are telling us gives you a leg up on the spot price. So the trades I've been making recently with Bitcoin have all been based on this sort of idea that we know that these flows are coming in. You're the one who taught me that about VWAP, and what I didn't understand was that I was like, why is it responding so well? Why is the price responding so well to the volume weighted average price? Until the book that you you showed me from Brian Shannon explained, it's because the institutions are using VWAP. And because they're using it, you have this feedback mechanism where you get to see a little bit of how they're making their plays. And if they have to buy $10 million worth of shares, they're just not going to buy it at any given price. They want to get a price that's less than the volume weighted average price, or shorted higher than if they're shorting it. And now it makes total sense. Why is it bouncing there? Well, because there's an order there for 10 million shares that needs to be done over the next 3 weeks. Right. And then it goes up, and then it pulls back, and it goes up and pulls back. You're like, okay, now it's making sense. And options are essentially the same sort of way in the 3D model, in the 3D space.
Yeah. And I found that VWAP, especially across asset classes, tends to correlate pretty highly. Even looking at like VWAP of the underlying constituents or components of an index tend to line up with the index itself. So I would imagine that institutions, even those that are selling options, tend to have to dance around the VWAP line as well.
That's right. And I love that idea that let's say some institution wants to buy a large block of shares, so they hire a broker or some person to do it, and that person they essentially sometimes have to guarantee beating the VWAP price. Like you were telling me this on Wednesday that Warren Buffett will put in a trade and he'll be like, well, guaranteed VWAP level, and the person buying the shares sometimes has to take a hit on it because they have to give a price that's equal or better than VWAP. And I just love that sort of knowledge. It makes me feel like I get to peek behind what's happening in the big leagues, because as a retail investor, you're not there like, oh, I have to make sure I get the VWAP price. But the idea that millions or billions of dollars, they need to depend on that, makes me feel like a lot more control, a lot more edge in my trading.
I totally agree. I think that there's anytime you can follow the flow of capital from a volume perspective and understand who makes up that participation and where the majority of that activity is coming from, it does give you a better understanding of how markets are really constructed in terms of the cohorts of participants, right? So you've got the institutional involvement, you've got high net worth individuals, you've got investment banks, you've got retail, and all of those flows in aggregate represent some pretty large percentages of the reason that price moves. So watching how institutions respond to certain technical levels pretty consistently is helpful, because it gives you a better and stronger understanding of why markets respond at certain price points. In general, I think the vast majority of retail traders are sort of taught this basic understanding of support and resistance. And I think that becomes in many ways a self-fulfilling prophecy as we get to areas of resistance and we start noticing that rejection and we get confirmation of that rejection. There's a crowding effect, and then everybody's jumping at the opportunity to sell that rejection because that starts to give us some belief that this is how people are going to respond, and then it's like a giant echo chamber. So the understanding the structure of markets and why participants are behaving the way that they are does give you that edge in my mind as well.
And explains the sine curve you see in markets. You go, why is it going up and down in this oscillating wave? It's because it's human emotion and desire and behavior that's then affecting. Because it's not going to bounce off support. If the guy says it's not going to bounce off support, but then it does bounce off support, you go, oh, but I got to get back in because now it's going to go the other way. And then they go in, and it turns out, oh, there's not enough support or not enough volume. Now it comes down the other way, and then it gets back to support and it goes up. And the person says, well, now it's the second time it bounced there, and I wait for the second touch, and then you have a new set of buyers that go in, and you're like, oh my god, this is such a fun game to see. I wanted to now the interesting thing about the 50 basis point cut is not just the structural flows and the types of trades you can do on that, but also what it says about the nature of the economy that we're in right now. And I just wanted to play you this clip from Daniel DiMartino Booth, who was on Fox Business News talking about this. So let's play it, and we'll see it on the backside.
And already you can hear it. The hand wringing is loud and clear. Joining me now, QI Research CEO, Chief Strategist, Daniel DiMartino Booth. Just, Daniel, your initial reaction when you heard that.
For the first time since Paul Volcker, I will tell you that Jerome Hayden Powell defied the markets. They've never gone with less than a 79.8% probability of a move, one way or the other, and they went today at 61%.
But here's the thing I kept telling people. At Jackson Hole, that whole week leading to Jackson Hole, every member that spoke said gradual, gradual, gradual. Right. I feel like he deliberately did not use that he kept the door open for this move.
He absolutely did, and he orchestrated this purposely, but he defied the markets. Charles, this is a good thing.
Let's talk about historically now. Okay, our first rate cut, going back 14 recessions. By the way, our buddy Kobasi put this together. I think it's fantastic. The unemployment rate in the past year, typically going into an unemployment rate that with the recession, right, up 9%, without a recession down 10. So look at this. I mean, the unemployment rate is rising so much faster than normal before first rate cut. Right. Real GDP, this is actually pretty good. You know, I'm going to change. I'm going to do this differently. I'm going to call that a red flag. I'm going to say this is okay. But look at this. The debt, U.S. debt up 123%, obviously a red flag. Right. Savings rate has plummeted 2.9%. Normally it's 8.8%. So again,
you had a
lot of red flags here.
A lot. Absolutely. Charles, the U.S. economy is not prepared for what the polls are telling us is going to be gridlock in terms of emergency measures, blowing up the deficit spending to alleviate the recession. We are not in a good place going into this as we have been historically.
Let's talk about another thing. I'm going to pick up a little bit on this. So the economy, right? One thing we talked about is savings. Foreign net savings, that's in the blue. When you just talk about a U.S. savings.
Net national savings, yes.
Negative. It's negative. I mean, how can an economy, this is not a soft landing. We just continue to consume more than we make.
No, I think Wall Street wanted to believe the soft landing narrative so badly that, as you said, only 9 out of 114 were even willing to go to 50 basis points. But that way you just circled, that's reality.
Jay Powell saw this. Bowman didn't necessarily see it, but she was always sort of giving off hawkish vibes.
He was going to get a dissent either way.
You made up a great point in your note, and I wanted to share it with the audience.
Right, that's good enough over there. So essentially, this is just one data point among many that's showing that even though the labor market is still fairly strong, what are we at, 4.2, 4.5% unemployment rate in the United States, which is not like too terrible.
Right. And I want to remind everyone that we pulled back 10 basis points on the unemployment rate in this last report. So we're down now to 4.2. But generally speaking, like that's full employment. We're not at a point yet in which I would be terribly concerned about the unemployment rate.
Well, I didn't want to. I didn't finish playing that video because it goes on for a little bit longer. But she does make the point that consumer spending, is still up. It hasn't slowed, and that hasn't been like a harbinger for recession. You can have consumer spending up into a recession, but the idea that savings is low. So we have high prices, savings is low, consumer spending is still up, and the labor market is not bad. And so you have this weird mix of, there's all these signs that are precursors to a full-on deep recession, and then all these other signs that are showing, no, we could probably have a soft landing and even um, uh, a larger bounce in markets, even a rebound inside of the general economy. And it makes me like really wonder, like there's no way for me to know what side to land on, but I'm curious about, as far as recession watch is concerned, if there's anything that you'd be looking for like, hey, if this sort of thing happens, um I, I'm thinking recession is a severe recession, as demonstrated by higher employment rate and a drop in the stock market. If that's, you're going to say that's in the cards, because currently the yield curve that uninverted, right? That seems to be not the scary boogeyman that it was before, and the unemployment rate ticking up from the bottom hasn't really rang any alarm bells. So I'm wondering if you think it's like the recession is sneaking around the corner, and what you might be looking for.
Yeah, I mean, that's where it's kind of tough, right? Like the main thing that I tend to look for, and I think we talked about this last week, is that the market will give us the early warning signal. The market's drawdowns tend to be the warning sign, because I think there are so many different variables that can tell us about the any type of impending recession, that the market is likely to reflect that in price, right? It's all baked in typically. And so I would be looking for some kind of extreme pullback, some kind of greater than 20% pullback that starts to get to a point where this is looking pretty darn bearish, but increases in volatility. As I look back at every recession in history and look at what price action told us at that point, the leading indicator is always the market. So that's the first thing I'm going to look for. What's happening on NASDAQ? What's happening on S&P 500? The problem with recessionary data is that we don't know we're in a recession until the data is like finally published 3 or 4 months or 3 to 6 months later, because we don't get GDP data except once a quarter. We don't get unemployment data except once a month. And so this data that we're relying on that's supposed to tell us whether or not we're in a recession is really kind of non-existent until we're already in a recession. So the best thing we can use in terms of an indicator is really the data available through the market, which of course is our ultimate judge, or our scale or weighing machine, if you will, of everyone's sentiment about where we're going, which should hopefully include some of that intelligence that we hope for, the common conventions, the collective wisdom of the market that's telling us like, hey, we've looked at everything. Here's every variable you can consider, and it's all baked into the price. So I tend to lean on the market more than anything.
Okay, so I completely agree, which means let me know if you think this follows. So I think you're in the same camp with me that, let's say we do get a 15% drawdown in the stock market. We're not talking about 10 years of a down market, because they're going to come in, either options flows will come in and bring the market up because people will monetize their hedges. The central banks will come in and pump it up. We can expect that a V bottom, essentially, if we get any severe drop. I mean, that should be the expectation with everything that we've seen over the last 10 years. V bottom. Would you agree with that?
We've covered that several times on the show as well. We've talked about how fast recoveries have been lately, and how the Fed and the federal government have basically acted as an artificial stopgap to any type of major drawdown in markets, which, the libertarian in me says, well, I would appreciate a free market. I really would. But at the same time, if you're an investor in the later years of your life, and you've got a portfolio you're relying on for retirement, you don't want something like that. But for us, I would love to catch price at a 50% pullback. I would love to be able to rebalance a lot of my portfolio into a better price on NVIDIA, a better price in the SPY or XLK. So, I guess it sort of depends. Like where are your incentives for something like this? But yes, we have spoken many times in the past that that in general recoveries seem to be swift.
The thing is, people like you and I can get the market down 40, 50% if we get these large volatility spikes because we're prepared and we're watching it, and we would buy that, whereas the regular Joe Blow is not doing that. And so what I wonder what follows is that if that's going to happen, then the wealth effect doesn't actually. In fact, the wealth effect gets exacerbated because as the V bottom happens, then the assets go higher still, and now your portfolio is worth more of the assets that you're just holding. And so I'm wondering here, the Daniel was talking about here the savings for Americans on average is negative, but if we can still keep borrowing against or still keep benefiting from the wealth effect from the rise in the markets, are recessions now really just pullbacks in value of collateral and not like we don't care about the contraction of productivity within the markets because we seem to no longer really care about that. Tell me if I'm wrong here.
I think you're right. I think there's one variable that is the a part of the numerator that maybe we're ignoring in general, and that is wage growth in the United States. That wage growth, I think, is contributing to continued persistence in consumer demand that makes it unusual in terms of our interpretation of what we expect to start happening pre-recession, right? We typically expect consumer demand to slow as unemployment starts to rise. There were a lot of surprising figures that showed up during COVID as well, where like there was this persistent rise in unemployment, but then consumer spending didn't really wane as much as people anticipated. And a big part of that was that there were many two-family homes in which the cost of childcare was so high that it was actually cheaper for one person to leave their job and have the other person retain their job while going on unemployment during that period of time. So it created this sort of artificial effect where the household is still creating income, still spending at the normal pace, in fact, spending more on online services and for, delivery services that created this transition in markets where we were kind of moving consumer demand from one sector to another sector. I think we're about to see something like that here too, where wage growth, I think, will contribute to an increase in consumer demand that we didn't anticipate, which could, sort of slow some of the impacts of what we think a recession might be here in the coming months.
So I love that you said that because that is exactly how I feel too. So let's get this. I think, and I think Kim is right. He's been talking about this, and some other people do, that we're not going to get any more rate cuts. We won't get any hikes, but we're not going to get any more rate cuts because we're going to get a re-acceleration of inflation over the next couple of data prints between now and let's say February.
It's possible. Now,
yeah, because they started cutting before we actually got back to 2%. Right, because they were saying that they're trying to engineer a soft landing, and they sort of want to jump the gun here. Right, they put two cuts in at once. They're using the expectations-based policy of the Fed in order to get people to buy into the markets, and so they don't want a soft landing. But they're supposed to do not only focus on employment, but also price stability. Right, and we don't have the price stability at the moment. We're still have rising prices. Prices are not going to come down, and so they're sacrificing that inflation in order to get the growth. And so it seems absolutely clear that if they're going to engineer any soft landing at all, and we're not going to get that recession, which is usually that cleansing effect that causes people to drastically change their spending habits, drastically start saving, whatever that causes the buildup of the savings that is the impetus for getting out of recession into the expansionary phase. If we're not going to do that, and we're going to just skirt that and get an expansionary phase, then we should expect inflation to come back, and we should expect inflation to come back hard. But while the Fed is holding the front end of the curve down, the 2-year rates, the short-term rates down, so we can get, let's say, 2.5% interest rates on the 2-year and 15% on the 10-year, because if the inflation does come back, future expectation of inflation is that it'll continue higher, and we would be re-accelerating inflation from a higher level than we started at the beginning of this whole inflationary thing, which means inflation will go crazy. What does that turn it into? Wage inflation, right? Wage inflation, which then people have to compete more, and more money goes into the market. Plus this extra thing.
But wait, there's more.
Yeah, the border issue in the United States, right? It's the big issue of the campaign. So much so that Republicans, who were usually pro-open border, as far as free trade and that sort of thing is concerned, pro-open border, they've moved now towards closed border because of Donald Trump. And Kamala Harris has switched from let everybody in to no, we have to have secure borders, back into the whole like Clinton era sort of democratic idea. So both sides now are about this closed border. Well, if they actually go through with that and they do the deportations or even just close it, that's also going to add to wage inflation, because we're not going to have that cheap labor that's coming in from abroad. So that's higher wages from the inflation, and then higher wages again from the closed border and the protectionism, or whatever it is you want to call it, whatever actually happens after the election, which means we should see inflation, rocket over the next year and a half, 2 years. Just an insane level of inflation while they keep the rates down. I don't know what kind of market we deal with that is. The only thing I know about that is from the 70s, where stock markets or assets that are not inflation sensitive are no longer your friend. But to me, it's like the most exciting thing. Depressing for a lot of people, I get that, but if it's going to happen anyway, I might as well be excited by how interesting it is. And we haven't seen it in our lifetimes. I don't know how you're preparing for anything like that.
Well, I was going to ask you that question. What is your inflation hedge then?
Crypto is my inflation hedge. Short bonds.
We've figured that out, though, that crypto is not an appropriate inflation hedge. It hasn't provided the protection against inflation we hoped for.
So we're at 60,000 in Bitcoin when we have high inflation, right? Like you wouldn't have expected.
We've had declining inflation for months now. Like that, we're almost on target. In fact, I think we've reached the Fed's target rate, right?
Yeah, we're at I think 2.5.
2.5, right?
Yeah, but there's these phases that happen within a change, right? So we had talked about in the last show that inflation is not strictly the number itself is not the problem. It's the volatility of it. Is it going to stick around? How much higher is it going to go? The uncertainty of it.
Sure.
We don't really have that same uncertainty now, because we had this ebb within the inflation. But let's say it starts rocking back up, we're going to get that volatility again. And if that happens, money is going to start chasing performance. Okay, what are you going to put into it? You're going to put in gold? Sure, gold has been up, but it hasn't been up like, we're not at 5,000 like people were talking about gold a couple of years ago. You're going to short bonds? How many people are there going to be shorting long-dated bonds? Like that's not a trade that people are normally doing. You're going to go long the short term? Maybe not, because who knows if the political pressure is going to cause the Fed to have to raise the rates drastically, so you're not going to want to be there.
Okay.
You're going to go into tips. You're going to go into break-evens. These are not instruments people are expecting like gangbuster numbers on.
Well, there's also some major limitations with tips and some of the insurance protected products. There's limitations in terms of how much you can even invest in those. So I think the last time I checked the product, there was a $10,000 limit. So if you've got a fairly decent sized portfolio, that's
I didn't even know that.
That's not helpful.
You won't be able to go into real estate because we'll have the same problem we have now, where they can't sell the house. You're just sitting on it, and plus you're not going to refinance if you have a lower interest rate. So where are you going to go to? You're going to go to something that's going to show performance, right? So you're going to have to go to some areas in tech and some areas in crypto. To me, it seems obvious. And actually, there's one area that you actually brought up in the last show, which is energy, that I sort of like poo-pooed, and because I was like, oh, energy, they're gonna, new technology to come and blah blah blah. But with the new AI bump, in fact, let's jump into this right now.
Yeah,
to
we'll
segue
jump into
next
the
story.
Microsoft story for sure. Switching gears to Microsoft buying an entire nuclear power plant to support the power load demand that is increasing for AI. I think this is a fantastic story because I think it clearly highlights one of the substantial issues with the AI movement, which is the demand for power. And yes, there is a reason that I am investing a fair percentage of my portfolio into XLE, which is the energy sector ETF.
So, I mean, I didn't really see it coming. I know people have been talking about this whole the whole uranium play, right? So uranium and said nuclear plants. I didn't really expect the sentiment around nuclear to change anytime soon. I know abroad they've been doing it because they've had some really rough issues, but I thought it would have to be some major crisis that would cause the public change. No, turns out money was the thing that changed people's minds. That AI data centers that could potentially generate billions or trillions of dollars gets people off the sidelines in order to lobby the government in order to cause nuclear reactors to come back online. So I don't know if you remember this, but like 3 months ago, what's his name? Bill Gates had released. It was like a groundbreaking thing on a new type of power plant they were doing. But now what we saw the other day is that Microsoft is willing to. That was Bill Gates' like foundation for power plants.
Bill and
But now we're
Melinda,
seeing
yeah.
But now we're seeing
whatever
that,
it's called now.
right. The Microsoft they're going to be investing, was it $16 billion over the next 20 years into the into this nuclear reactor, and they were seeing all these different data centers for AI being. I think Amazon just had one recently that was set up next to a nuclear reactor, and so now forget the regular Joe Blow people like lobbying our members of parliament and congressmen in order to give us nuclear energy. The rich people are like, we need nuclear energy right freaking now. And what we've seen in the uranium stocks as a result is these huge rise. Did you see Cameco went up 8%, Uranium Energy Core went up 8%. Next, all these stocks just gapped up on this news. Let me just pull up the chart real quick.
Sure.
Yeah, so you had these assets that essentially gapped up just this from their lows, and uranium now is starting to become like the thing that we want to be paying attention to. So if we go to Cameco CCJ, look at that gap up. And we've already been in this long-term trend with uranium because there's not a whole lot of uranium in the world. I mean, there's enough to satisfy our needs, but the question is who controls them.
Right.
And Russia controls a lot of it. China controls a lot. So it's sort of like, this political issues we have to deal with over there. And so there's a question of American and Canadian mining resources that are not going to get a bunch of investment because you can't do this last minute, right? If you can invest at all in nuclear energy, you got to do that 10 years ago. You got to do it now. And so we're seeing a bunch of money flood into there. So it could be that uranium stocks end up doubling, tripling over the next 5 years and become amazing plays. I'm surprised how this has flown underneath the radar. I mean, those who are paying attention, they're the uranium bugs who are just completely, I don't know if you ever listened to them. They're on FinTwit, they're all over the place. To them, uranium is better than gold. They've been talking about it for years.
Right.
But just like Bitcoin becoming legal tender in El Salvador and it becoming more used as a currency, uranium now is becoming seen as like going to be as good or better than fossil fuels. And so it could be another 10 years now of a golden age in uranium and energy within the United States and Canada, which is something we haven't seen for a while.
Interesting observations. I think, unfortunately, the XLE doesn't really have any exposure to, public uranium companies or even URA as part of the 25 components that make up the sector ETF. So I'll have to give that one a look. But In general, I mean, energies, to go back to what prompted this conversation, which was, what are you doing for your inflation play, right? My interest was in any industry that specifically stands to benefit from inflation, and energies tends to be one of those industries. In large part, your energy demand does not wane even through a recession. You're still going to need nat gas. You're still going to need to power your furnace. You're still going to need power for your home. You're still going to need to charge your electric car. So, the overall demand for energy doesn't wane as much, and of course the pricing is generally pegged to the cost of inflation. So, what better place to be in than in energy stocks, because those are obviously of benefit. So XLE is definitely an interesting one for me. That was a quick play. It was a one-time, all I had to do was click buy instead of had to go do a bunch of research. But you make an interesting point about the demand for uranium and overall how we're going to be able to support the power load for the AI sector, which is like slowly becoming this whole new multi-billion-dollar industry that we now need to sort of reform our thinking about, because it has demands and CapEx requirements that are sort of unique on its own.
And it's causing these large players to be able to get over the hurdle of, because a lot of these nuclear plants that are still around are, I think they call them stage 1 or stage 2, where they're not like cost effective. Like even if you get them online, you're paying too much. But for how much they're expecting to be able to get out of AI, they go, well, then now that price is worthwhile, and just spin them up. This is 3 Mile Island. The power plant is in. People, there's boogeyman tales and stories and old folklore about 3 Mile Island that kids tell each other, and now they're like spinning up because it's going to be worth the money. To me, it's just unbelievable. And the double, people talk about the, like you just said, the need for energy, that we're always getting that energy.
Mm-hmm.
And Bill Gates talked about that in an interview that he did a few months ago, about when he started up the new nuclear power plants that he's talking about. And as a side note, he was saying, oh, and by the way, we're going to need it for AI. And when really it's the AI thing, because it's, what is it, double the energy output usage of a given nation is what's needed to run the AI in that nation. It's like, I mean, forget our microwaves. This
Right.
is like, I mean, and this is to start with. They want 5 times that. They want 10 times that. And so what happens when so many nations then decide to become independent energy wise, and what that does for the local economy could be pretty interesting. What it does for war abroad, like what if we're not fighting for oil anymore because we figured out energy, and we did, countries are competing to advance what's happening with the nuclear power development, and then we get over the whole thing about, oh, it's not green. No, it turns out it's more green than a bunch of other things, and stable and cheaper, and blah blah blah. Golden age, to me, like you said at the beginning, you're optimistic. This to me is squarely in the golden age category, even though it's run by oligarchs and billionaires and children.
All right, so let me give you a few thoughts to, I think, the chess move that we're trying to define here, right? We're trying to think a few steps out that help us decide on what we invest today because of the impact we think it'll have in the future. I don't think there's any question that power load demand is going to increase, and obviously the demand will be there for some time. One callback that I have, though, in like the history of me speculating on the future of industries, is the impact that the crypto industry had on NVIDIA graphics cards. And as I was thinking through the chess moves there, the very first thought was, well, NVIDIA is clearly going to benefit from all of the cryptocurrencies that rely on GPUs in order to mine for crypto, and the demand should continue to increase there. Well, sure enough, that's how it played out. But the one thing that I didn't anticipate, which would have been chess move number 2, is, oh, how about revising the way that this crypto works to rely on proof of stake instead of proof of work? So that dramatically decreased the need for those GPU cards, and then obviously that pulled back a lot of that demand. NVIDIA's stock pulled back, and then we got to see it take its most recent run during the AI game. Now, I want to think through that process again with the AI industry, but I'm pretty sure this is more of a physics question, and maybe somebody in the comments can help me out on this one. But I don't think there's any potential major optimization that's coming from the need for graphics cards in order to support LLMs in the future, other than maybe software advantages. Maybe at the software level, we could make some improvements to the way that the LLMs behave and they require less energy over time. But as far as I can tell, the type of media demand we're requesting from AI technologies, video interpretation, video creation, audio creation, audio interpretation, the speech to speech, those mediums are so intense in terms of their compute needs that I don't think that demand wanes. But what are your thoughts, Tom? I mean, as we're trying to think through, like, what could cause the demand for energy to pull back? Is there some major innovation from at the hardware level? Do we defy the laws of physics somehow to require less compute demand? Or is there a software optimization coming?
I don't think there's anything. Energy is not like other types of technology where the what you want is to use less of it. You always want more of the energy because you get that stored potentiality to use for something else.
Sure.
So I'm not anticipating a pullback in the need of it. I think what we get instead is the exact opposite. That more gets produced. That the productivity and development makes it so that we have so much more energy that we're looking for ways to use it, as opposed to the other way around. And so even though I think that the systems you're talking about that would be using these energies would become more efficient and need less energy, I don't think that then results in now there's a pullback in the demand for energy. We'll just find new ways of using it. In the same way as money,
Sure.
we don't go, well, we need less money because we're more productive. You actually need more money the more productive you become.
Well, I guess the problem I have in my mind is that it seems like there's some potential to overproduce capacity for producing energy. And since we can't really reliably store energy in any meaningful way that makes it distributable to the human population that is still growing, there's going to be some kind of supply-demand problem here in the future, where if we are able to improve the efficiency of AI models to the extent that they need even half the energy required today, then that demand will come back need to be pulled back at some point, right? So if we've overproduced capacity to support AI in the future of AI, what then happens to that industry? So that's sort of what I would be looking for. I don't think we're anywhere close to that. It's still, we're obviously on the rise of this industry, and the demand is obviously incredibly high. But eventually, I think somebody somewhere is going to be like, look, man, we're melting polar ice caps faster than ever before because of how much AI is out there. So we got to do something about this.
So you think energy storage then, like, let's say they could solve that problem, would be like gangbusters?
I don't even think it's possible. I don't think we could store the energy that we're producing now and in the future in a reliable way to make it useful in the future. That's the problem. It's like what we're going to end up with is overcapacity. We have the potential of producing enough energy to support AI at its current scale and at its current growth rate. But if the need for that energy starts to dissipate in any meaningful way, then we've got overcapacity.
I see. It's like maple syrup here in Canada. It's like everywhere. It's like, all right, it's nothing. No one even invests in it.
Right.
All right. Okay, interesting. Okay, I'm going to look into what the next domino for that could be, because there's something in me that doesn't resonate well with the idea that there's too much energy. I think there are things that we want to do that we're not doing because we don't have enough energy, but I'm guessing. And
Right.
that the oversupply then makes the energy costs come down so much that things that are on the sideline now becomes available. That's how
It's possible. It's possible. I think it's just a trade-off, right? Where does that energy go? And I just don't think that the human population and the demand for energy on at a consumer level can even hold a torch to the demand for energy from AI right now. Like, that's the reason that Microsoft is buying an entire power plant on nuclear, and why they're investing so much in this, because the future demand for AI technology is significantly higher than residential, commercial, or even just human demand for power. So that need for power, even if our population increases another, let's call it 4 million, 40 million people, or 50 million people over the next year, that's still not enough demand to match the demand for AI. That's my thought process, but maybe I'm off on this. I'd love other people's opinions on this.
It's fascinating. All right. Okay, so we'll leave that there. I mean, there's so many things we could talk about, but it just will never end. We'll leave our predictions for crypto and stock market off to the side. Instead, I'll just mention Kem's prediction for the S&P, which is 6,000 or 6,100 by mid-January. At which point he says, watch out that the next OPEX, right, for March is where you're going to want to. If we do get the blow off top to 61, you want to get puts, expect the downside drop, and then start getting calls for late March and June, because the V will be, a rocket ship.
Swift.
And so I'm looking for exactly. I look forward to that.
Well, this has been a good one, and thanks again for joining us, everyone.
Ciao.